Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Ty. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about 2019 fall financial tips. We look at it sort of based on the season here. As we're coming towards the end of the year, we'd like to challenge everybody out there to look at some of these tips and get them in place before we start the new year. And first thing we're going to look at is something that affects your investments, and that's the process or the term called tax loss harvesting. This is a process where you might have accounts, mainly those non-retirement accounts, that can show losses in your portfolio. For some reason, a stock or an investment fell out of favor. Maybe the sector's no longer producing. Maybe they're affected by tariffs. And you've had enough patience with them, but at the end of the year, you still show some losses. If you were able to sell that investment at a loss, it's going to help your tax situation. So it's one of those things where you want to go into it and look at it with your eyes wide open. At times, it's advantageous to sell off at a loss so you can take that advantage you have from a tax standpoint, turn that money back around, and invest in something that might be a little bit more in favor. However, we also warn clients when they want to do this, you don't want to do it specifically just for tax purposes. Many times you have situations that could affect your investment portfolio, and people won't make changes to the portfolio because it's either going to be a taxable gain or a potential loss. So you look at it proportionately and say, okay, are you willing to, offset potentially $3,000, $4,000, $5,000 in a loss to protect $200 or $300 in a tax situation? So again, tax loss harvesting, as we get towards the end of the year, we look at the possibility of selling some of the investments that fell out of favor at a loss. That's going to help your tax situation, and then start anew with some investments that might be in favor at that point. What else, Tyler, should we talk about when it comes to tax loss harvesting?
Yeah, Dean. So with tax loss harvesting, as the end of the year nears, it can definitely be a beneficial tool to save on taxes. And where it comes into play is, like you had mentioned, with non-retirement accounts. So with your non-qualified accounts, oftentimes we might see where a husband and wife, they have a jointly owned account. These would be the accounts where tax loss harvesting applies. This will not apply within your 401k, your IRA, your Roth IRA. So just keep that in mind. But if you have paper losses on investments, so again, that's where if you were to sell off an investment, you could be able to take that loss on different things like stocks, ETFs, mutual funds, different investments that you might hold in a brokerage account outside of your retirement accounts. Then you can sell those investments at a loss and realize some tax savings up to $3,000 per year, and you can carry forward unused amounts to future tax years as well. So keep that in mind, up to $3,000 per year you can use in tax savings. Now, a little example here to kind of illustrate is if you buy $10,000 worth of Apple stock, for example, and a year later it's worth only $9,000, then you can sell it and realize a loss of $1,000 that you can use to offset your taxable income to help you reduce your taxes in the future. So again, if you have an investment, if you sell it at a loss, you can use that loss then against your income to help lower your taxes. But you can only do it for up to $3,000 in a particular year, and then anything after that you can carry forward. So if you do have a loss of, say, $5,000 or $6,000, then you can use $3,000 of that loss in whatever particular year it is that you sold the investment in. But then even if you don't do anything else that next year, you can also take that $2,000 or $3,000 and carry that forward to the following year. So that is something that does allow you to, if you make moves within your investments, you can save tax-wise. But one very important thing to note is you cannot buy back that same stock or similar investment within 30 days of selling it, or else the loss will be disallowed. Because that's called a wash sale rule, where if you were to sell an investment and then you could buy it right back, you could take that tax loss and it wouldn't even matter. So that's something that the IRS doesn't allow. They don't want people doing that. Otherwise, everyone would be doing that and kind of playing the system that way. So one thing to keep in mind is if you do make that move, you can't buy back that stock or similar investment for at least a month or 30 days. So keep that in mind. And Dean, like you said as well, one thing that we want people to know is when it comes to tax loss harvesting, you don't want to make investment decisions solely based on taxes. They factor in, but don't do it only because of taxes. You could really screw up your whole investment plan if you do it only based on your tax situation.
Okay, good points, Tyler. The second thing we're going to talk about that we'd like to discuss with our listeners, for the fall financial tips would be, sort of the opposite of the first topic, which was, tax loss harvesting. We're going to talk instead about harvesting gains or taking profits off the table. Very, very important. There's an old saying that you never realize a gain in your portfolio until you sell at a gain. You never take a loss in your portfolio until you sell at a loss. So, unrealized gains and losses are going to vary, and you're going to see them on your statement all the time. And, when people say, well, last month I lost X amount of dollars, or last month I gained X amount of dollars. Well, you really didn't. The portfolio, it's all unrealized. It becomes realized, though, when you do sell some of those losses or sell some of those gains. So we're going to talk about the second thing here, and that's harvesting gains. A good example is at the end of 2018, there was significant volatility in the market, and the market went down pretty substantially in November and December. However, there were enough indicators out there to show that volatility was going to lead to a choppy end of the year. For some people, though, it was deeper than they expected, which is part of the stock market. There's never a certainty in it. But at the end of the summer last year, it's a good opportunity to constantly look at rebalancing your portfolio. Ask your financial advisor, when you meet, is my portfolio being balanced often enough? And we'll talk about that, a little bit later in the show here. But through the process of rebalancing portfolios, you look at significant gains. Tyler brought up, just as an example, for instance, Apple. Apple has been on a tremendous run over the years. So many times people will carry certain stocks in their portfolios that continue to gain. And if you truly want to get a gain in the portfolio, it's a good time to maybe go and sell some of those gains, take them off the table. In other words, you move them into a cash position, and then you can either reinvest those into something else within your portfolio to rebalance, or you can add a new holding. So many times we'll also do that. We'll take some of the gains off the table. Other times we'll take dividends and we will redirect those into cash positions. So if we have a significant holding that's doing very well and we want to diversify out of it a little bit, we'll take the dividends instead of reinvesting back into that particular investment that's gaining substantially. We'll have the dividends go into cash also. So we're building up the cash opportunity in the portfolio so we can then take the gains off the table, add to it the cash that's currently sitting there through the dividends being reinvested into cash, and then buy more equity positions within the portfolio, hence giving you a better balanced portfolio. Tyler, what else as far as taking gains off the table?
Yeah, so when it comes to, again, the other fall financial tip, we have tax loss harvesting, and then we also have harvesting gains, or taking the profits off the table, which that's the flip side of harvesting losses. It'd be selling investments at a gain before the end of the year. Now, people do this for a couple different reasons. Some people do it because if their regular income is low enough that they might fall into the 10% or 12% tax bracket, then they could qualify for a 0% tax rate on long-term capital gains and pay nothing on their investment profits within your brokerage account. Now, again, that's an account that you have that's a non-retirement account. So we have plenty of clients that have these accounts, but this wouldn't apply for your non-retirement account. It would apply for your non-retirement account. It would not apply for your 401k or any type of retirement account that you have. But really what happens is if you're holding a non-qualified or a non-retirement account, then whenever you take a withdrawal or whenever you sell an investment, you pay taxes at the long-term capital gains tax rate. And right now, if you're in the 10% bracket or 12% bracket, then you would pay 0% in long-term capital gains. So that's a strategy where people who, if they manage their income and they fall into the 10 or 12% bracket, they can take investments that have done very well, sell them off, take profits off the table, and then they won't have to worry about paying any taxes when that would happen. Now, if you're otherwise in the 22% bracket or higher, so it goes from the 12% tax bracket, then the next one up would be the 22% bracket. 22%, then you would pay 15% on long-term capital gains. So 12% is where you won't pay anything. So that's what some people do. Again, they'll sell off investments at a gain when they otherwise would have to pay taxes on them. But if you fall in the 12% bracket or lower, you wouldn't have to pay any tax on that. Now, you might also, so that's one thing where people really do it from a tax standpoint to save on tax dollars and pay at a 0% long-term capital gains tax rate. But the other thing would be you might have substantial gains from investments that have benefited from the recent stock market run-up. Now, again, right now we're coming into the last quarter of 2019. So far in 2019, the market has been up, but it's also been up for a number of years, basically the last decade as well, ever since the crash back in 2008. We've had a big stock market run-up, and each and every year people have investments that continue to gain. And toward the end of the year, internally we refer to it as giving them a haircut, where you take a little bit off of the gains, take that money, put it into cash, and that will help you risk manage. And now might be the time toward the end of the year, because coming up on 2020, it's an election year. There's a lot going on geopolitically with the U.S. and China trade dispute. So what we see many people doing is taking some of their investments that have done well over the years, and they're not selling off the whole entire position. They might simply pare it back. You might have $20,000 in a particular stock. You might sell off $5,000 of gains and keep $15,000 in the stock, but then take that $5,000 and move it into cash. That will help you risk manage. So that's something that you can do to try and capitalize on a 0% tax rate, as well as risk manage your portfolio, is harvesting gains and taking profits off the table.
Okay, Tyler, good points. The next one we're going to talk about is rebalancing your investments. So, we have this as a tip to do each fall before we get into winter and the new season. There are all different schedules for rebalancing portfolios, and it really depends on what type of investments and holdings you have and what are your objectives and time horizon. There are some portfolios that we rebalance on a monthly basis, a weekly basis, quarterly, and annually. It all depends what type of holdings. It all depends what type of momentum or lack of momentum some of those investments have. But really, rebalancing, what it does do is it brings back into play those investments that drifted away from your original percentage you wanted to have in the portfolio. So we refer to it as drift. They drift away from the original target. So for instance, if you have a particular investment that you want to make up 25% of your portfolio because it fits your risk model, it helps you with your income needs when you retire, your time horizon, and so on, and that 25% becomes 30, 40, or 50% of your portfolio because it's done very well, where some others may have become laggards, looks awfully good. But if that heavy position now gets hit due to geopolitical issues, due to missing earnings reports or tariffs or international trade, it could bring your portfolio down more significantly than you are prepared to see it go down. So you want to rebalance your investments, again, all different time frames. If you're working with a financial advisor, ask them how often they rebalance your portfolio, not just all of them, but your portfolio. And if you don't have a financial advisor and you are investing on your own, go back and look at your original desires when you put that investment in the portfolio and find out, is it becoming too large of a position in your portfolio or not? If it is, you need to rebalance. Is it becoming too small of a position but adds safety or income needs, and now it's no longer relevant because it's so small compared to the rest? You need to rebalance. Tyler, what else am I missing here with rebalancing?
Yeah, so rebalancing, it entails cashing in some profits on your better performing investments and then reinvesting those profits into some of your laggards or your positions that might not be doing as well as of late. And really, when it comes to rebalancing, the whole strategy assumes that hot investments, they'll cool off and laggards will eventually pick up which is usually what happens over the course of a few years. Now, for example, what rebalancing is let's say you have 4 different funds within your 401k, and they're allocated at 25% each at the beginning of the year on January 1st. Now, when the end of the year rolls around, instead of having 4 different funds at 25% allocation each, you might have 2 funds at 35% each and 2 funds only at 15% each. So what happens is over the course of any market cycle, it can throw off your allocation and your diversification if you don't rebalance back to the original 25% across the 4 different funds. Now, what happens is if you continue to leave it, then obviously your investments are going to get thrown out of whack, and you're not going to be diversified like you thought you were, and that can lead to more substantial losses than you would have otherwise expected. So, rebalancing, it helps manage risk within your investments, and it's a buy low, sell high technique. And right now, during a year like 2019, with the market up 15 to 18% so far, you might be top heavy in stocks and different positions that are a little bit more aggressive. So right now, rebalancing into different bond positions and positions that are a little bit more conservative might benefit you heading into 2020 now, where we expect there to be continued market volatility. But one other thing to keep in mind when it comes to rebalancing is that it works best within your 401k, IRA, Roth accounts, different accounts where you don't incur taxes on each trade. So the first 2, tax loss harvesting and harvesting gains, the first 2 things that we talked about, those work best in your non-retirement accounts. Now, rebalancing, that works best in your retirement accounts, because whenever you rebalance, you want to make sure that it's an account where you're not taxed on every little trade, which that would be the case within your 401k, your Roth account, your IRA. So that's where rebalancing works best in. And it's usually what we recommend is if you have a personal account or your 401k, you want to do it at least once a year, if not twice a year. Or you could also make changes after a big market swing that could throw your investments way out of whack. So for example, at the end of 2018, the market lost 20% in 3 months. That could really throw your investments out of whack. Same thing where if the market gains 20% in 3 months, after a big market swing, that would be a good time to rebalance. But if you don't do it then we recommend at least once a year, go in there, check your allocations. Again, I'll go back to the example. If you have 25% in 4 different funds, check those every single year. You want to rebalance back to that 25%, provided those investments are still fitting your financial plan.
Okay, before we go on to the next item, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next fall financial tip we're going to look at is going on autopilot. And that's both a mindset and a process. And we're going to talk about the mindset first as far as autopilot. And that is, if you're not involved with a 401k, you need to get involved, okay? Or your 403b. It's the quickest way that you're going to generate wealth, other than maybe hitting the lottery or inheriting something. 99.9% of the people we talk to generate their wealth through their employer's program. So get involved. Don't overthink it. Too many people say, well, I need this money because I'm starting a family or getting a home. We all have gone through that, and you're going to have other reasons as you get older not to get involved. You need to get involved as quickly as possible and stay involved. So that's the mindset. Put it on autopilot. Make the commitment and let it go. The second thing when it comes to autopilot is find out, does your employer have a process that each time you get a raise or a bonus, that automatically would be a 401k heavier contribution. So look at that to find out if you can contribute heavier at the times of bonuses or a raise. Also, if your employer changes their contribution, they might match up to 3% and then it goes to 4%. Make sure that you are auto-enrolled. So if it goes from a 3% to a 4% match, you're involved. You don't have to read all the emails and go through the meetings to find out this happens because you're automatically enrolled. It would be a shame to find out that your company increased from 3 to 4% and 2 years later you realized it. If you're auto-enrolled, you don't have to worry about that. Tyler, what else as far as autopilot?
Yeah, good points there, Dean. Now, if your employer offers a 401k or a similar retirement plan, obviously you need to sign up if you haven't already, and especially if they offer a match, because we talk about it all the time on the show, but you could be missing out on free money if you're not taking advantage of that. And the reason why we say that is because we see it all too often where I'll meet with people, whether they're younger workers, even middle age, and they're not taking advantage of their 401k. And I ask them if they have a match, and they said, yeah, I think it's 3 or 4%. Well, if that's the case, then you should be putting in at least 3 or 4%, because it's only going to hurt you. It's free money that your employer is giving you that you're not taking advantage of otherwise. And a little example here is if you make $50,000 a year and your employer offers a 4% match. So a 4% match is pretty standard. I see it with a lot of different 401ks that people might have. But again, that'll vary all over. Some are 3%, others might be 1%, others might be 7%. But for example, you make $50,000 a year, your employer offers you a 4% match, which that means that if you contribute 4% of your salary, which 4% of $50,000 would be $2,000 a year, which I think many people can budget around and afford to do that, then your employer will also put in $2,000 a year out of their own pocket. Now, $2,000 a year invested over 40 years, averaging an 8% rate of return per year, will yield you over $500,000, and that would really be all out of your employer's pocket. So as you can see, if you don't take advantage of that, you could be missing out on possibly hundreds of thousands of dollars over the long term in retirement savings. So again, go on autopilot. You want to make sure your 401k is set up. You want to make sure that you're at least contributing up to the match if your employer offers one. And just auto enrolling and auto escalation is another thing. And auto escalation, that's where your contribution amount, you might set it up to start at 4%. But then every 2 years, it automatically, at the beginning of the year, automatically increases 1%. And then 2 years later, it increases another 1%. So that's something, and so on. So that's something that can be very effective to save more, because people put a strategy in place and then they don't even have to think about it, and they continue to contribute for years and watch their account grow over time. So it's something where it's the whole out of sight, out of mind philosophy, where you want to put that on autopilot. For sure, you want to be contributing at least up to the match if your employer offers it. Put it on autopilot, and then again, you want to also, with your contribution amounts, you want to also try and put those on autopilot, where over the years those are automatically going to increase as well, to see if you can work your way up to the 15% of your income in retirement accounts, which is what we talk about all the time.
Okay, good points, Tyler. The next one we're going to talk about, we'd like you to do this annually. Too many people don't do it annually or at all, and that's review your estate plan. If you don't have an estate plan and you're investing and you have a family, you really should have an estate plan. The very basics, such as a will, a living will, powers of attorney, and so on. We like to recommend to our clients that they meet with our attorney, or any other attorney for that matter, to have a will or a trust or your estate plan reviewed every 4 to 5 years. And sometimes it's not because you have changes within your own life or your own family. Sometimes it might be the state has some changes. So you need to look at that. But the number one thing when it comes to reviewing your estate plan, you have worked your whole life. You've accumulated as much money and tried to be as diligent as possible looking forward to retirement. But then you cut corners assigning beneficiaries to your accounts. And we see this a lot, especially with bank products such as, checking and savings. Sometimes they don't allow you to put beneficiaries on there, maybe a joint owner, husband and wife or significant other, but there's no beneficiaries. So if something were to happen where you both perish, then you're leaving it up to somebody else to determine who gets that money. So on things like cash positions, especially at a bank, if they don't have beneficiaries tied to it, you want to ask for a transfer on death document. It's called a TOD, transfer on death document, so you can make sure that if something happens to you, these cash positions are available to your loved ones in the way that you wish. The other thing, too, is a big mistake that we see people make is, again, it's just taking the lazy way or ill-informed way out, and that is they will put down, they have a number of loved ones, a number of children, and they will put to the estate of, and that is not what you want to do, because even though it's going to your estate, you are assigning somebody else to determine who, what, and when it gets paid out. So make sure your beneficiaries are updated. Every year, go back and ask your financial advisor and the bank if you can review your beneficiaries, just to make sure that things are in place the way you want them. With 99% of the investments out there, those can be changed. They're called revocable. You can change them at any particular time. However, in the state of Wisconsin, if you are married, we are a marital property state. And what that means is your spouse receives your money in a situation of retirement accounts should you pass away, unless your spouse agrees not to and signs off on it. So Tyler, what else should we look at when we talk about reviewing your estate plan?
Yeah, Dean, this one's pretty basic one, but it's important because not everyone does it. But again, this fall, review your estate plan. Make sure you have the right people listed when it comes to on the documents when it comes to those who are going to take over your wealth once you do pass away. Make sure legal documents like your will, powers of attorney, maybe you have a trust and different beneficiaries on investment and retirement accounts. Make sure they're all up to date. Make sure they're all accurate. Because really the last thing that anyone wants is to pass away and have their money or financial decisions go to someone who they don't want making those decisions or inheriting that money. And we see it happen all too often when really it can be prevented by simply taking, 5, 10, 15 minutes, reviewing your documents, making sure everything is up to date and the right beneficiaries are on there. So review your estate plan. That's something that you definitely want to do this fall.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.